All right, good afternoon, everybody. I hope you can see me here as well as hear me well. My name is Elliot Toda. I am excited to be with you today to discuss opportunity zones for investors. Uh, we are going to try to keep this to half an hour, make sure that everybody can get back to their busy schedules. And I'm looking forward to sharing a little bit with you today about why opportunity zones are creating such a buzz and how they might benefit you in your investment strategy. Before we get into the meat of things, I have to go through a pretty standard disclaimer here. We are a real estate development firm. We are not a tax, legal, or accounting firm. So any investment that you seek to undertake, please be sure you consult your tax, legal, or accounting advisor before you do. Also, and I'm going to get into this a little bit more here shortly, we've made every effort to make sure that the information that we convey to you is accurate, is up to date, and is reliable. Opportunity zones are a moving target at the moment. So as I'll get into a little bit later here, things might change, things might fluctuate. So please verify any information before you do choose to make any investments. Just a little bit about us. My name is Elliot Toda. As I said, I'm the president of the Oxbridge Group. We're a real estate development firm. In our 21st year, we have done a significant amount of development throughout the Mid-Atlantic region, both residentially and commercially. And we are increasingly focusing on infill development within cities, within established areas, which is actually very relevant to opportunity zones. So let's dive right in. Also, if you have any questions during the presentation, please don't hesitate to send me an email. To the extent that we have time at the end, I'm going to be able to answer those questions to the best of my ability. So if anything comes up to you, that's my email address. You should all have my email from me sending out the call-in instructions. So feel free to shoot me a response back. I'll be checking them, and then I'll try to make sure that we leave a little bit of time to get to any of your questions. All right, so opportunity zones. I'm sure people have seen opportunity zones in the headlines. These are actual headlines, what you have before you, from various publications speaking about opportunity zones. And there's really a lot going on. There's a very, very big buzz about investing in opportunity zones, the types of opportunities that they offer, the caveats that come with investing in them. So what we're going to try to do here is really break down the basics of opportunity zones. I know that some of the attendees here have various degrees of understanding of real estate, of opportunity zones. So I'm really going to start from the bottom up and try to speak to it as comprehensively as possible. What I will not be doing is speaking about it from a real estate development or really, a tax and formation standpoint. This is really intended for investors so that you can get a better idea of how this could impact your own investment portfolio. So there's a lot of buzz about opportunity zones, and let's try to understand why. So the Opportunity Zone program was created as part of the Tax Cuts and Jobs Act that was passed a little bit over a year ago. It was actually tucked in there. Treasury, the IRS, was very, very surprised when it was passed, because this did not come from them. It actually came from a think tank called the Economic Innovation Group that came up with this concept. And so that is actually extremely important in terms of, and I'll get to once I explain the program, how it's actually playing out, because the IRS and Treasury have been playing catch up on this since that time. But the Economic Innovation Group basically was seeking to find a way that they could combat geographical inequality in low-income community census tracts. So what is a low-income community census tract? It is a tract in which the poverty rate is at least 20%, or tracts in which the median family income does not exceed 80% of the statewide median family income. So in short, they're impoverished areas, they're areas that are in need of development. And they were looking for a way, how can we encourage and boost development in these areas? And what they realized was that there is a tremendous pot of capital sitting in the United States in the form of unrealized capital gains. People who have capital gains, whether it's in stock, whether it's in businesses they own, whether it's in real estate, don't want to realize those capital gains because of its implications in terms of the taxes it will create. So they basically said, if we can somehow match the need of development for impoverished areas with unrealized capital gains, we could have a real opportunity here. So this is just some sort of a little bit of dense information about the program itself. The program is built around encouraging investors to invest in these opportunity zones, encouraging investors to invest their funds into boosting development and raising the future prospects of these impoverished areas, quote unquote impoverished areas. There's no public money that's part of the program. The investments stand on their own 2 feet. This is not that you develop or you invest in an area and the government's giving you money to do so. Absolutely not. There's a tremendous amount of flexibility in how much you invest and what you invest, and I'm really going to get into that. The only things that, one of the few limitations in terms of what you can invest in are no-sin businesses. So if you're a big massage parlor investor, this may not be for you. Tanning facilities as well. So, certain limitations, but let's get into the meat of it. So 8,700 opportunity zones have been designated throughout the United States. You'll see them dotted all over the map of the lower 48. You'll see a significant amount of Alaska at the bottom of your screen is an opportunity zone, small bits of Hawaii on the bottom left, and the entirety of Puerto Rico on the bottom right. The entirety of Puerto Rico is deemed an opportunity zone. So these are 8,700 zones that encompass 11% of the United States population. Comparing opportunity zones to non-opportunity zones, opportunity zones have 40% lower income levels and 38% lower home ownership than non-opportunity zone areas. So as I said, this really is targeting more, lower the areas that have not seen development, that have not seen investment, that do have greater poverty than the average. And so when you're investing in an opportunity zone, you're inherently investing in one of the areas on this map that are colored in orange. You can see some of them are quite small, some of them are really a radius of several blocks, and some of them are quite large, encompassing thousands of acres. So the way opportunity zones work is as follows. As an investor, if you have unrealized capital gains, you own Amazon stock that you invested in a couple of years ago, you have a business that you're able to sell, you have a piece of real estate that you're able to sell for a profit. Those are unrealized capital gains. If you actually sell that asset and realize those capital gains, okay, you invest them into a qualified opportunity fund, and that opportunity fund then invests them into either residential properties in opportunity zones, commercial properties in any opportunity zone, or also even businesses that are located in and that operate primarily in opportunity zones. Any one of those work. It's really a very broad swath. So you invest in these opportunity zones, assumedly you see appreciation over time, hopefully, and you're able to benefit from those, from that investment. Now, what does it mean to benefit from that investment? There are 3 primary areas, 3 primary benefits that you get from investing in a qualified opportunity zone fund that then invests in an opportunity zone. The first is when you sell whatever asset it is that you have your unrealized capital gains in, you are not required to pay taxes on those capital gains at that time. You are required to pay those capital gains at the earlier of when you sell your opportunity zone investment, or December 31, 2026. Really, it's April 2027, as if you had realized that capital gain in 2026. So you have a deferral. Let's say you're investing in 2019, you have a deferral, assuming you're holding long-term your opportunity zone fund, which we'll get into, because that really is what this is built for. This is built for a long-term investment. You do not pay any taxes until, let's say, December 31, 2026, the 2026 tax year, so April 2017. When you pay those taxes, they're reduced from what they would normally be. So right now, capital gains, long-term capital gains tax rate, and this does apply to both short-term and long-term capital gains. Long-term capital gain tax rates without any state tax is approximately 23.8%. Depending on your income category, but let's just go with 23.8%. So instead of paying that today, you're going to pay that in April 2017. When you pay that, assuming you've held your investment for a minimum of 5 years, the amount you would pay is 10% less. So you actually only pay 90% of the tax you would have paid if you've held your Opportunity Zone investment for 5 years. If you've held it for 7 years, you get an additional bonus, and instead of only paying 90% of that tax, you only pay 85% of that tax. So there's a benefit in deferring when you have to pay your capital gains tax. There's a benefit in reducing the capital gains tax, and both of those are actually the smaller portions of the true benefit, because the true benefit of Opportunity Zones is if you hold your investment for 10 years or more, then whatever you've invested in, when you sell that after that 10-year mark, all of your proceeds are entirely tax-free. It's going to help to go through an example, but that is truly the crux and the true tremendous benefit of Opportunity Zones, that when you invest in an Opportunity Zone and you hold that investment for 10 years, you do have tax deferral on the original amount invested, on the original capital gains invested. You do have a reduction of the amount owed on that original amount. But then any appreciation that you see in your investment is 100% tax-free. And that has the ability to significantly boost return in these investments. So again, here we just have a timeline showing, depicting what I just spoke to. Year one, let's say you invest in 2019. By the time 2024 rolls around, you've held the investment for 5 years. Any tax you're going to have to pay, let's say you sell it at that point, is going to be 10% less than what you otherwise would have paid and is deferred. Assuming you hold till 2026, you achieve another 5% reduction on the tax you would have paid. With then tax being due regardless, April 15, 2027. Again, 85% of what you would have originally had to pay 7+ years prior. And then any sale 2029 and beyond, all the proceeds from that sale are tax-free. So let's look at that, what that actually means. So this is a table that basically says, okay, let's say that you take capital gains of $100. Okay, and that's going to appreciate for the life of your investment at a flat 7%, what you see under the appreciation rate. One is saying if you were to take that $100 and invest it in the stock portfolio, after tax at a 7% appreciation rate, after 5 years, 7 years, and 10 years, these are the returns you'd have. These are the after-tax funds available. And just next to that, you have an investment in opportunity fund. Again, assuming the same 7% appreciation. You'll see that at 5 years, there's a benefit based on a $100 investment of $9 additional. That's equivalent to an after-tax annual rate of return boost of 1.9%. After 7 years, you actually have $15 more in your pocket. That's an annual boost of 1.8%. And then you'll see, again, assuming the 10 years, assuming a 10-year plus hold, or in this case, a 10-year flat hold, you actually end up having $44 more in your pocket, a 3% annual after-tax boost, which again is significant. That 3% over time really adds up. So let's go through an actual example. Let's say that you did make that Amazon stock investment, or you made a real estate investment. And either way, you have a $1 million capital gain pot of money that you can choose to realize, and or that you're required to realize, you choose to realize, whatever it might be, but you have $1 million of capital gains that you can invest. Looking at the left side of this chart to begin with, okay? You take that $1 million gain, and you're gonna have to pay taxes on it if you're not investing in an opportunity zone. So what is that tax? For a Texan, it shows it at $238,000. For a New Yorker, almost $365,000. Why the difference? State tax rates. So even the state you live in could have a material impact of how much benefit you get from this opportunity zone. So after you pay those taxes, in Texas, you're left with about $762,000, New York, $635,000. You invest that at, let's say, whatever it is, a new taxable investment, be it real estate, be it a new stock, be it anything else, at 8% a year, okay? After 10 years, That amount that you invested grows to the numbers you see at the bottom left of your screen, 1.645 or 1.371 million, and then you have to pay taxes on those rates as well. So in the end of the day, the Texan ends up with 1.435 million, the New Yorker with 904K. Again, this is based on a pre-tax $1 million capital gain realization. Now, let's look at the right side, which is the opportunity zone side. You take that 1 million and you invest it in 2019 into an opportunity zone, okay? And what we're gonna assume for the purposes of this example is that you're making that same 8%. So 2026 rolls around, okay, or April 2027, excuse me, which is when you have to pay the taxes. And you have to pay a reduced amount, 85% of the tax you would have otherwise paid on that 1 million. So it's as if you're paying taxes on 850,000, not a million. And you'll see at that point, the Texan has to pay taxes of just over 200,000 and the New Yorker over 300,000. And then in year 10, after that new investment has appreciated 8% per year, okay, they're able to sell it. And inherently, it's a larger number because they invested $1 million. They didn't invest the after-tax amount of $762,000 and $635,000 respectively. They invested a larger amount of $1 million. They're able to sell that for $2.159 million. After the tax, or it's not a tax, but deducting the amount of tax they paid in 2027, they end up with after-tax proceeds of $1.957 million as a Texan, compared to the 1.435 that they would have through a conventional investment, and for a New Yorker 1.849 compared to 904,000. What you can see here is that regardless, that is a material difference in terms of the return that they're able to realize, especially in high income tax. When you have a high state income tax like New York, you're literally seeing your money double as compared to what it would have been, assuming the same rate of investment. So this is a spectacular example in terms of illustrating just how significant the gains can be for investing in an opportunity zone. People, particularly in real estate, may have heard that opportunity zones are like a 1031 on steroids, a 1031 exchange. This is a little bit specific to real estate investment, a comparison, but the comparison is made so often that I thought it might be valuable to actually compare the two and what are the differences, what are the benefits. So a 1031 exchange, speaking first to like-kind requirements, 1031 exchanges are only available if you've sold or if you've realized a capital gains on real estate, okay? If you realize a capital gain on real estate, you can do a 1031 exchange to defer that capital gain realization. With an opportunity zone, it's not limited to real estate. You can do stock, you can do businesses, you can do real estate, you can do arts, antique cars, whatever would fall under the definition of a capital gain. So it really has a lot more flexibility than a 1031 exchange. Small point 1031, you need to use an intermediary. Opportunity zone is simpler than that. There's no intermediary. You take your funds, you invest them directly into an opportunity zone fund, and you're able to benefit from it that way. This is another significant one, reinvestment requirement. On a 1031 exchange, when you sell a building, or sell a property, you have to take the entirety of the principal you originally invested and the gain and reinvest that into a like-kind property. With opportunity zone, the only portion relevant for investment is the capital gains portion. So you actually are able to then take the original principal that you had invested and do whatever you want with it. The only part that's relevant to opportunity zones is the gain, which actually gives you a little bit more, or potentially significantly more money that you can pocket. And you don't have to invest all of your gain. You can invest whatever portion you'd like. Initial property identification, 1031 has all sorts of timing limitations of when you need to identify your property that you're going to be rolling into. Opportunity zone, you don't have to preempt or prior to realizing the gain, you don't have to realize or identify your investment. The only requirement is that within 180 days of realizing that capital gain, you've invested it into an opportunity zone fund. So you can't go back and say, I sold something in 2016. I want to put it into an opportunity zone fund now. It has to be within 180 days of realizing the capital gain that the money is then in an opportunity zone investment. Continuous deferral of tax is possible. So in a 1031, you can assumedly roll your gains into a new property, sell that, roll it into a new property, sell that, sell that, sell that, and never really realize your capital gains. With an opportunity zone, come hell or high water, however long you hold it, you're realizing those capital gains in April of 2027. So in that regard, 1031 exchanges actually do hold a little bit of a higher leg, because you could theoretically never realize your capital gain until you pass, until your death, when your gain would step up, for those who are familiar with 1031s. But in opportunity zones, like I said, regardless of how long you hold it, it's either the earlier when you sell it or the 2026 tax year, and taxes being paid in April of 2027. And lastly, again, capital gains reduction or elimination. The only way you can do it in a 1031 is when you die. Assuming you're holding a property that was 1031, your basis automatically steps up. With an opportunity zone, no death required. As long as you hold the property for a minimum of 10 years, you will pay no taxes whenever you choose to sell that property. Whenever you choose to sell that property, provided that that sale happens between 2040 or before 2047. The opportunity zone program ends in the year 2047. So to realize the no taxes benefit, you have to have sold by 2047. That is 28 years from now. So I think there's more than enough time in there to assumedly sell the investment. So as an investor, there we go. What are the things you should consider? What is going to make an opportunity zone investment relevant to you? First of all, do you have capital gains? If you don't, you need not ask any further questions, because if you don't have capital gains, you're not going to qualify for any of these benefits. So again, if you have capital gains unrealized in stock, in any of the categories I've already mentioned, then you definitely have the option of doing this. If you don't, unfortunately, that's not the case. If you've recently sold something, like I said, within the past 180 days, and you can invest it within that time frame, that works as well. But if there are no capital gains, there's no opportunity zones. Second question, do you have the patience for a 10+ year hold? I tried to bold the plus sign. I didn't think that was enough, so I threw in an arrow as well. To truly benefit from this program, your money needs to be locked away for 10 years. If that doesn't work for you and your investment strategy, again, opportunity zones are really, at that point, the benefit is not nearly as much as it could be otherwise. So ideally, you want to have the patience for a 10+ year hold. And why do I say plus? For a couple reasons. Number one, in 10 years, we don't know exactly where the market's going to be. And selling at that 10-year mark may be a big mistake if we're in a very, if we're in a down market. And it may make sense at that point to wait another couple of years for things to recover. So you have to assume a 10+ year hold. The other reason it may make sense to even hold it for longer is, again, you're able to realize no taxes on that opportunity zone investment once you hit the 10-year mark, regardless of when you sell it up to 2047. So if you choose and the property is appreciating nicely and continuing to, that market is doing well, that area is doing well, you may choose to hold it for 20 years, because then when you do sell it after that 20 years, that entire additional gain between years 10 and 20 is also tax-free. So prepare yourself for a minimum of a 10-year hold. The next consideration, as I said, the taxes are going to be due on the outside end in April of 2027. At that point, assuming a 10+ year hold, you would have not realized your investment return. So either your investment through ordinary income needs to turn out enough capital to provide you with the funds to pay the tax that you're going to have owed on that original capital gains investment, or you have to have liquidity otherwise. So it's very important to realize that there is things are not 100% joined up in this program. It's not built to give you the funds you're going to need to pay that tax in 2027. So you need to make sure that when you enter into this, that either your investment is going to spin out enough ordinary income over the course of the first several years to provide you with the capital that you're going to need to pay the tax in 2027, or that you have cash on the sidelines that you can use to do so. Number 4, am I able to identify good investment options? Do I trust the OZ fund operator? So this is I want to go back to what I spoke to in terms of Treasury being blindsided by this program. It was brought into law over a year ago. The clear regulations on the program have yet to come out. IRS is struggling. They promised that there would be a clear set of regulations on how the entire program would work in spring of 2018, then summer, then fall, and finally a set of regulations did come out at the end of October. Another further clarifying set of regulations is supposed to come out in the following weeks, and then the final set may not come out until summer, is the current prediction. So, and there are all sorts of things you have to do to make sure that you're qualifying on the operator end, on the developer end, to make sure that you're investing. There are all sorts of funds that have already taken capital as of months ago. And so the question is, do they know what they're doing? Are they going to be able to conform to the requirements as they come out? And yeah, do they have what it takes? Do they have the wherewithal to really keep up with this for the 10-year plus period? Because if they don't, you could find yourself, even though you followed all the rules, if they didn't follow all the rules, you might find yourself out of luck. Do I have faith in the investments? So this is an important point. Not all opportunity zones are created equal. If you look at the map, and I'm happy to send a link to find the map, or you can do your own Google search. It's not hard to find at all. If you look at the map, you'll see areas all over the country, in urban areas and rural areas, just in different states, everywhere. So not all opportunity zones are created equal. Some are in areas that are already, let's say gentrified, developing, have a significant amount of development going on around it that, will lift that area. Others are in the middle of nowhere. Others are absolutely in areas that will not see a significant difference over the course of the next 10 years. So you have to kind of know, okay, wait, where am I investing? If I'm investing in a fund, is that fund investing in multiple markets? Is that fund investing in one market? Where is my money going to go? Because a 0% tax on $0 is still $0. So you want to make sure you're actually seeing appreciation to take advantage of this program. And lastly, should I invest now? So this is a sort of a little bit of a push and pull that's going on with the OZ guidelines. You'll recall that I said that there are tax reductions that happen in years 5 and 7 of holding it, but by no later than 2026. What that means is you have to make an investment in 2019 to take full advantage of that 7-year reduction. Because that 7-year reduction sunsets at 2026. So if you don't make an investment in 2019, you're inherently not going to be holding it for 7 years prior to that sunset date. So you want to take full advantage of the program, you have to invest by the end of 2019. Is everything clear at this point in 2019? Not 100%. Will it be soon? Hopefully. If you invest in so let's say you invest in 2020, you'll have only held it for 6 years by the time that 2026 date comes. So you'll still get a 10% reduction on your original taxes for holding it for 5 years. Those taxes will still be paid in April of 2027. Assuming you hold it for 10 years, you'll still get that big boost of the tax-free portion of the investment. But you won't get that additional 5% reduction in your original capital gains. If you invest after 2021, you wouldn't even have held the investment for the 5 years required. So you'll defer your taxes until April of 2027, but you'll get no reduction on them. Again, assuming you hold the investment for 10 years plus, you'll still get that no capital gains tax on the investment on the opportunity zone property or business or whatever it is that you've invested in. So there's a push and pull. Should I invest now? I want to get take full advantage of this program, but things are still coming together a little bit. So again, make sure that you're investing in something you're confident with an investor or a vehicle, a fund that you're comfortable with. How can I invest? There are many funds that are being announced that are starting online. Some of those are geared towards let's say the individual investor. People are very familiar with Fundrise. Cadre is another one, which is backed by famously Jared Kushner, supposedly, and his family. These are two investment vehicles that are available sort of to the individual investor. You do some Google searches, you'll find even more. We are starting an opportunity zone fund specific for properties. So we're not going to be commingling a bunch of properties. We are starting an opportunity zone fund for one opportunity that we have identified in Northeast DC that we're excited about. If anybody is interested, we're going to be raising some money for that later on this year. Feel free to contact me if you'd like to get more information. So there are opportunity zone funds out there. I think I hope I've tried to discuss some of the pros and the cons, whether this is applicable to you, whether it's not, and what type of things to take into consideration, because you do have to invest intelligently. You do have to be the right type of investor with the right type of investment horizon. And so I hope that's made sense. This is my email address. I'm also, you should have a raise hand option on your screen. And if anybody would like to raise their hand, I've muted everybody just to prevent any background noise. But if anybody would like to raise their hand and ask a question, I'm more than happy to field them. I did receive one question via email. So the question is, what happens if you if you get an offer on a property? Let's say you invest in an opportunity zone fund. Yeah, this is, okay. So you invest in an opportunity zone fund, and let's say that the opportunity zone fund gets an amazing offer to sell the property in year 5. They want to hold it till year 10, but they get an amazing offer. It would be stupid of them not to take it. Can they sell that? So the answer is in one of these gray areas of what part of the regulations that are still making themselves clear. But the answer is that inherently, yes, the mechanism is being built for you to sell that in year 5, but within 180 days, you're going to have to take all those funds, reinvest them into an opportunity zone, and then make sure that your opportunity zone developer, fund manager, whatever it is then following all the requirements of that of opportunity zones in that new investment. One of the things I didn't touch on, again, trying to focus on this from an investor perspective, but it's an important note, is when somebody invests into an opportunity zone, it's not just that they can buy something and hold it for 10 years. They have to materially improve the property. Or in the case of an opportunity zone business, they have to significantly increase the tangible property of that business. So this isn't I'm going to go invest in an opportunity zone, I'm going to forget about it for 10 years, end of story. If I'm buying a building, whatever the value of the building is, not the land, but whatever the value of the building is, I need to invest at least that amount of money into improving the building. So this is not just invest in these areas and forget about it. This is invest in these areas, improve these areas, raise the bar on these areas so that these areas, you really take them from being a quote-unquote impoverished area and you take them to a different level. Again, I say quote-unquote because some of these areas are less impoverished than you would think. Others are absolutely impoverished. So if you were to sell a property in year 5 that you've already improved, you have to take all the proceeds, invest in a new property, and improve that property as well. So as long as all that's followed, it looks like you're going to have the opportunity to potentially shuffle investments during that 10-year period. But again, IRS should be coming out with more guidance on that soon. Let me see if there are any other questions. There are no other questions that I can see, and I don't see any hands raised. Everybody has my oh, I do have. So the question is whether opportunity zone funds are allowed to use debt. And the answer is yes, absolutely. Opportunity zones are allowed to use debt. The investment that investors make has to be equity. They can't invest in the form of debt. But you are allowed to use debt in doing the project. So investors are able to use debt, which as anybody who has invested in real estate or is familiar with real estate knows, that can provide a significant investment boost. So absolutely, debt is part of the game. It's just not it doesn't qualify for what the opportunity zone investment must be. Opportunity zone investors must invest in the form of equity. That's a great question. Thank you for bringing that up, Alex. Another question, why aren't opportunity zone and new market tax credit overlays on maps consistently aligned? The opportunity zone program is actually a lot more strict in terms of the impoverished areas. It actually goes after a higher level or a lower level of income, lower level of home ownership. So opportunity zones are generally not as prevalent as markets where new market tax credits are. But that's a great question as well. I don't see any other questions. I don't believe I see any hands, even though this is the first time I'm using this platform, so I'm not sure I would see hands. But if anybody does have any questions, you have my email address, you have my phone number in the emails I sent you. Don't hesitate to reach out to me. I really appreciate you guys taking the time to be here today. Thank you. I look forward to speaking to you, and I hope you have a great week ahead. Take care.